Thanks to all who have joined us by WebEx for standing by. Welcome to the open meeting of the Public Company Accounting Oversight Board. During the meeting, you'll be in listen-only mode. As a reminder, this meeting is being recorded and a recording is expected to be made available on the PCAOB website. I would now like to turn to Chair Williams to formally convene the meeting.
Good morning and welcome, everyone. This is an open meeting of the Public Company Accounting Oversight Board on September 19th, 2023. We welcome those of you who have joined us today by webcast or dialing into the teleconference. Before we proceed with the agenda, I will note for the record that all board members are present and participating in this meeting, and we are able to hear one another. The only order of business before the board today is a staff recommendation that the board propose for public comment amendments to PCAOB Rule 3502, which governs the liability of associated persons who contribute to a registered public accounting firm's primary violation of the laws, rules, and standards that Congress has charged the board with enforcing. To present the staff's recommendation, I will turn to our acting general counsel, James Capoli.
Good morning, Chair Williams and board members. The Office of General Counsel is pleased to recommend that the board issue for public comment a proposal to amend PCAOB Rule 3502. That rule governs the liability of associated persons who directly and substantially contribute to PCAOB registered firms' violations of the laws, rules, and professional standards that the PCAOB is responsible for enforcing. The PCAOB's mission is to protect the interests of investors and to further the public interest in the preparation of informative, accurate, and independent audit reports. To that end, Congress has mandated that the PCAOB enforce compliance with certain laws, rules, and professional standards, and that the PCAOB impose sanctions when appropriate upon registered public accounting firms and associated persons that do not comply. That mandate extends to violations by any registered firm or any associated person. It also includes violations committed negligently, that is, as a result of a failure to exercise reasonable care. Indeed, the PCAOB may impose sanctions when appropriate for a single act of negligent conduct that constitutes a violation, and it may impose certain enhanced sanctions when appropriate if a registered firm or an associated person has engaged in repeated instances of such negligence. Yet, the PCAOB's current approach to contributory liability does not fully align with the PCAOB's statutory enforcement authority. Rather, the PCAOB's current approach, as reflected in existing 3502, requires a showing of recklessness and requires the contributory actor be associated with the particular firm that committed the violation before contributory liability may be imposed. And therefore, today, we recommend that the board propose for public comment certain amendments to Rule 3502 that are intended to correct those misalignments. In just a moment, I will invite Damon Andrews to present an overview of the proposed amendments. Before doing so, I want to recognize several people who made significant contributions to this project. From the Office of the General Counsel, I want to recognize and thank not only Damon, but also Connor Rosso, Drew Dropkin, and Vince Meehan for their terrific work. From the Office of Economic and Risk Analysis, I want to thank Martin Schmaltz, Michael Gerbett, John Cook, Tian Liang, and Federico Garcia for their partnership and support. From the Division of Enforcement Investigations, I want to thank Bob Rice, Mike Davis, John Abel, and Bill Ryan for their assistance. And I also want to thank staff from other offices and divisions, including the Office of Communications and Engagement, who have provided assistance with this project. Lastly, I want to thank the Securities and Exchange Commission staff, including the staff of the SEC's Office of the Chief Accountant, for their support and timely assistance with this project. Damon Andrews of the Office of General Counsel will now provide an overview of the proposal, and then Martin Schmaltz and Tian Liang of the Office of Economic and Risk Analysis will provide some additional remarks before Damon closes with our recommendation. Damon, I will now turn it over to you.
Thank you, James, and good morning, Chair Williams and board members. I'd like to begin by providing an overview of the recommended proposal before the board to amend PCAOB Rule 3502 which, as mentioned, governs the liability of associated persons who contribute to firms' violations of the laws, rules, and standards that the board enforces. Nearly 2 decades ago, the board adopted Rule 3502, and in the years since, the board has brought charges in more than 80 proceedings under the rule. Based on an understanding of the board's experience and to better align the rule with Congress's grant of authority to the board under the Sarbanes-Oxley Act of 2002, the Office of the General Counsel is recommending that the board propose to amend Rule 3502 in 2 ways. First, staff is recommending that the board propose to change from recklessness to negligence the standard of liability for associated persons' contributory conduct. Second, staff is recommending that the board propose to amend Rule 3502 to provide that an associated person contributing to a violation need not be an associated person of the registered firm that commits the primary violation, or put another way, that an associated person of one registered firm can be liable for contributing to a primary violation of any registered firm. With respect to the change in liability standard, Rule 3502's current formulation places negligent contributors to firms' violations beyond the rule's reach. But registered firms can act only through natural persons. It logically follows, then, that when a registered firm is found to have committed a violation negligently, it is likely that such negligence is due to a natural person's negligence. Rule 3502, however, requires a level of culpability higher than negligence, at least recklessness, before the board can impose sanctions against associated persons who contribute to firms' negligence-based violations. Thus, under the current rule, associated persons who do not exercise reasonable care and thereby contribute to firms' violations may escape liability and accountability, even while the firms committing the violations do not. Accordingly, staff is recommending that the board propose to change the liability standard for an associated person's contribution to a firm's violation from recklessness to negligence. With respect to the second proposed amendment, Rule 3502 currently conditions contributory liability on the relationship between the firm that commits a violation and the individual that contributes to a violation. Specifically, Rule 3502 requires that the individual be an associated person of that firm. Although an individual who directly and substantially contributes to a firm's violation, as is required for liability under Rule 3502, in all instances likely will be an associated person of the firm committing the primary violation, staff believes that contributory liability shouldn't be contingent upon the individual's formal role or relationship with that firm, so long as the individual is an associated person of any registered firm. Accordingly, staff is recommending that the board propose to amend Rule 3502 to clarify that the rule applies to associated persons of any registered firm who contribute to a registered firm's violation, regardless of whether the contributory actor is an associated person of the firm committing the violation. Staff believes that the recommended proposal would enhance and promote investor protection consistent with the board's mandate under the Sarbanes-Oxley Act. In staff's view, changing to negligence the liability standard for contributory conduct would promote investor protection in at least 2 ways. First, we believe that it would make Rule 3502 a more effective deterrent from auditor misconduct, thereby encouraging auditors to act with reasonable care that they already should be deploying in their work. Second, we believe that it would make Rule 3502 a more effective enforcement tool by allowing the board to hold accountable negligent individuals who contribute to firms' violations. Additionally, the proposed change to negligence would align the board's liability standard for contributory conduct with the authority that Congress granted to the board. When Congress enacted Sarbanes-Oxley, it provided to the board the ability to sanction negligent conduct, including single instances of negligence. By no longer requiring at least reckless conduct to be liable for contributing to a firm's violation, the recommended proposal would better align Rule 3502 with the board's statutory authority. These same investor protection principles apply to staff's recommendation that proposed Rule 3502 no longer condition the availability of contributory liability on an associated person's formal relationship with the firm. The Sarbanes-Oxley Act imposes no such condition, and staff recommends that the board propose to align Rule 3502 with the authority that Congress granted to the board. Indeed, in staff's view, what matters is whether an associated person has directly and substantially contributed to a firm's violations of the laws, rules, and standards that the board enforces. I would like to draw the board's attention to two additional facets of today's recommendation. First, staff would like to point out that associated persons already are subject to potential liability, including money penalties, for negligently contributing to registered firms' violations of numerous laws and rules governing the preparation and issuance of audit reports via the Securities Exchange Act of 1934. Specifically, the Exchange Act authorizes the U.S. Securities and Exchange Commission to institute cease and desist proceedings against any person that is, was, or would be a cause of a violation of the Exchange Act or any rule or regulation thereunder due to an act or omission that the person knew or should have known would contribute to such violation. The Exchange Act further authorizes the Commission to impose a civil money penalty upon finding that such person is or was a cause of such violation. Thus, the proposal to amend Rule 3502's liability threshold would not subject auditors to any new or different liability standard to govern their conduct. Second, staff is recommending that the board propose to retain the directly and substantially modifier to describe the connection between a contributory actor's conduct and a registered firm's primary violation. Under the proposal, for conduct to directly contribute to a primary violation, it must either essentially constitute the violation or be a reasonably proximate facilitating event of or a reasonably proximate stimulus for the violation, but it need not be the final step in a chain of actions leading to the violation. And for conduct to substantially contribute to a primary violation, under the proposal, it must contribute to the violation in a material or significant way, though it does not need to have been the sole cause of the violation. In short, the proposed rule is not intended to reach an associated person's conduct that, while contributing to a violation in some way, is remote from or tangential to the firm's violation. To implement these amendments, staff is recommending the following proposed changes to the rule text of Rule 3502. To change the liability standard, staff is recommending that the language knowingly or recklessly not knowing, which sets a recklessness threshold, be changed to knew or should have known, which is classic negligence language, as reflected in the proposal. To remove Rule 3502's conditioning of liability upon the formal relationship between the contributory actor and the firm committing the primary violation, staff is recommending that the word that be changed to any, as reflected in the proposal. Staff is interested in receiving feedback on all aspects of the proposal and is recommending that the board allow 45 days for interested persons to submit comments, including in response to specific questions listed in the proposal. Additionally, staff is recommending that the proposed amendments to Rule 3502, if adopted by the board, become effective 60 days from the date of commission approval. Thus, under the proposal, any potential amendments to Rule 3502 would not be retroactive, but rather would apply only to conduct occurring more than 60 days after commission approval. Before I yield the floor to my colleagues in the Office of Economic and Risk Analysis to present their analysis of the proposed amendments to Rule 3502, I'd like to first publicly recognize and thank several individuals for their contributions to this recommendation. First, I'd like to thank Chair Williams and her staff, as well as all board members and their staffs, for working closely with the Office of the General Counsel to draft the proposal. I'd also like to thank my colleagues in the Office of the General Counsel, specifically James Capoli, Connor Rezo, Drew Dropkin, and Vince Meehan, for their invaluable input and guidance throughout the process and the run up to this recommendation. I'd also like to thank my colleagues in the Office of Economic and Risk Analysis, specifically Martin Schmalz, Michael Gerbett, John Cook, Tian Liang, and Federico Garcia for their insights into the economics of the proposed amendments. And finally, I'd like to thank the Securities and Exchange Commission staff, including the staff in the Office of the Chief Accountant, for their support with this project. And with that, I'll pass the mic to Martin for his team to say a few words about the recommendation. Martin?
Thank you, Damon. Good morning, Chair Williams and board members. The Office of Economic and Risk Analysis has performed an economic analysis of the proposed amendments. As always, the economic analysis includes establishing a baseline of firm performance under today's rules, identifying a need for rulemaking, evaluating the economic impacts of the proposed amendments, and assessing reasonable alternatives. We believe the economic analysis contained in this release faithfully and even-handedly sets out the likely economic effects of the rule, and we look forward to receiving public input on the release. In particular, relevant data and analysis would be most informative to any future consideration of this proposal. I'll now turn it over to our Economic Analysis Associate Director, Tian Liang, to present the details of our analysis.
Thank you, Martin. In the 14-year span between 2009 and 2022, the board has brought 87 cases under Rule 3502 for an average of 6 cases per year. These 87 cases represent 36% of the total number of cases where a firm was charged with a violation, meaning that in nearly 2/3 of such cases, no contributory actor was charged under Rule 3502. While there may be many reasons not to charge an associate person who is contributing to a firm's primary violation, in certain of these cases, the absence of a charge may be attributable to certain misalignments between the board's current accountability framework and the real-world ways in which individuals carry out their responsibilities vis-a-vis registered firms. As my colleagues in the Office of the General Counsel have pointed out, Rule 3502's current recklessness standard is stricter than the negligence standard for many primary violations, even though a legal entity cannot act on its own. Additionally, Rule 3502 currently requires the contributory actor to be associated with the firm that commits the primary violation before the PCAOB can hold a contributory actor accountable. The proposal would address each of these dimensions of the current rule. Importantly, however, the SEC already has the authority to discipline associated persons in these situations, and so the proposed rule would not subject associated persons to contributory liability for the first time, but rather give the PCAOB the concurrent ability to bring such charges. Thus, we expect the impact of the amendment standards would be modest but positive. To the extent that associate persons are not acting reasonably today because of certain features of the current rule, the proposal would increase the probability of sanction. This may in turn incentivize more associate persons to perform their duties with reasonable care, which will enhance the firm's compliance with PCAOB standards. To the extent that firms might otherwise seek to understaff key functions, the increased probability of sanction may prompt those firms' associated persons to advocate for sufficient staffing levels, which would reduce competitive pressure on firms that might desire to devote robust resources to ensuring compliance in the first place. The costs of this proposal are expected to be modest given the SEC's existing authority, while the enhanced enforcement authority provided by this rule would ideally prompt any associate persons not already acting with due care to do so. PCAOB staff nonetheless estimated that 2 to 3 additional cases per year might be brought under the proposed amendments. Assuming that firms might tend to indemnify associated persons against the cost of defending against contributory claims, firms would thus bear the cost, including attorney's fees, experts, and other resources of the legal defense. Associated persons who are the subject of the additional enforcement actions may be distracted from their revenue-generating activities. Finally, we acknowledge the possibility that these rules, if adopted, might result in unintended consequences, such as increased self-protective behavior, for example, additional effort to perform or document actions to protect against liability, or may deter personnel from accepting key roles. However, the existing, more extensive jurisdiction of the SEC over these matters means that the magnitude of the unintended consequences should be limited to the more modest effects resulting from giving the PCAOB the concurrent ability to bring cases. In summary, while we recognize the actual and potential costs, we believe the benefit to audit quality and investor protection of closing the jurisdictional gap justifies the proposal. I thank our colleagues in the Office of the General Counsel at the PCAOB and the SEC staff for their support in developing the economic analysis. I will now turn it over to Damon to present the staff's recommendations.
Thank you, Tian. In closing, the staff is recommending that the board issue for public comment a proposal to amend PCAOB Rule 3502 governing contributory liability in substantially the form provided to you. Thank you.
Thank you, James, Damon, Martin, and Tian. At this time, my fellow board members and I will have the opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. We're here today to consider updates to PCAOB rules so they match what investors already expect. That when an associated person's negligence directly and substantially contributes to firm violations that can put investors at risk, the PCAOB has tools to hold them accountable. To do this, we are proposing amendments to PCAOB Rule 3502, responsibility not to knowingly or recklessly contribute to violations. First, the proposal strengthens accountability for associated persons, including individuals and firms who put investors at risk, by updating the threshold for liability from recklessness to negligence, allowing the PCAOB to hold auditors accountable for failing to exercise the same standard of reasonable care and competence they are already required to exercise anytime they are executing their professional duties. Second, it clarifies that associated persons of any registered firm can be held liable for contributing to the violations of any registered firm, not only a firm with which they are associated, as long as their conduct at least negligently contributes to the firm's violation. While instances where auditors negligently, directly, and substantially contribute to the violations of firms with which they are not associated could be rare, arrangements among firms are becoming more and more complex every day. This clarification will ensure more complex firm arrangements, including some that we may not be able to contemplate today, cannot be used to evade accountability in the future. It is important to understand auditors are already required to exercise reasonable care or competence anytime they perform an audit, meaning they are prohibited from being negligent today. Similarly, the U.S. Securities and Exchange Commission already has the ability to seek penalties and enforcement actions against associated persons when they negligently cause firm violations. So there is no reason this proposal should cost auditors significant time, resources, or money. Simply put, if you are doing what you are already supposed to be doing, this proposal won't affect you. If you're not, there may be consequences. I also want to be clear, these updates are not intended to ensnare junior professionals or other auditors who are responsibly executing their duties. Again, to be held liable under the proposal, not only do associated persons have to act negligently, this proposal also maintains the current requirement that their negligence must have contributed to the firm's violation, both directly and substantially. That does not include auditors whose conduct is remote from or tangential to the firm's violation. Like many of the standards this board has voted to modernize, Rule 3502 is nearly 20 years old. Things have changed since it was first adopted in 2005. The SEC now has the ability to seek civil penalties and enforcement actions against associated persons when they negligently cause firm violations. The way that firms operate has changed, and the expert staff at the PCAOB who have seen how Rule 3502 plays out in the real world are recommending this update. We have both the benefit of experience and the responsibility to investors to ensure Rule 3502 is fit for purpose in today's world. That purpose is to ensure there are consequences when associated persons of PCAOB registered firms contribute to violations committed by registered firms, which can put investors at risk. Let's look at current quality control standards, for example, which impose obligations on firms, not individuals. Quality control is fundamental to firms consistently performing high-quality audits. And when firms violate the PCAOB's quality control standards, the consequences for investors can be significant. Quality control failures impact everything from client acceptance and continuance to independence to the execution of audit engagements to supervision and review. But the firms are not making the decisions and taking the actions that result in quality control failures on their own. People are making these decisions and taking these actions. Similarly, some PCAOB independence violations can only be directly committed by firms, including violations that undermine the audit process and can put investors at risk, like failing to obtain audit committee pre-approval for audit or non-audit services, or providing services for an audit client for a contingent fee or commission. Again, firms don't make the decisions or take the actions that lead to these violations on their own. People participate in these decisions and actions. Those people are auditors, highly trained professionals with specialized skills and ethical duties who are licensed and paid to carry out duties solely entrusted to them. When they fail to exercise the reasonable care or competence entrusted to their profession, and that failure directly and substantially contributes to a violation by a firm, investors expect there to be consequences. Investors deserve accountability. The two changes we are proposing today will ensure Rule 3502 lives up to those expectations with the accountability investors deserve. I encourage all our stakeholders to read the proposal and provide your perspectives. I'd like to express my gratitude to those individuals who have significantly contributed to this proposal. Specifically, I'd like to thank the Office of General Counsel, James Capoli, Connor Rasso, Damon Andrews, Drew Dropkin, and Vince Meehan, and the Office of Economic and Risk Analysis, Federico Garcia and John Cook, with support from Tian Lang, Michael Gerbert, and Martin Schmalz, and in the Division of Enforcement and Investigations, Bob Rice, Bill Ryan, John Abel, and Mike Davis. I'd also like to thank my fellow board members and their staff for their contributions to this proposal. In addition, I'd like to recognize the support provided by the Office of Communications and Engagement. And finally, I'd like to thank the Securities and Exchange Commission staff for their support and assistance. I will now turn to my fellow board members for any statements they may wish to make or questions they would like to pose to the staff. Board Member Disparti, the floor is yours.
Thank you, Chair Williams, and good morning, everyone. I do want to join Chair Williams in expressing my appreciation to the staff for their expertise and their efforts in developing today's proposal, including spending substantial time with me and my team throughout the process. I support seeking public comment on today's proposal to amend our Rule 3502 on contributory liability. Integrity and accountability are essential to high-quality audits and to investor trust and protection. Rule 3502 has been an important tool at our disposal to hold persons accountable when they recklessly contribute to violations by registered firms with which they are associated. Today, staff, as you've heard, is proposing to lower the threshold standard of conduct for contributory liability from recklessness to negligence. On its face, the proposal seems appropriate and reasonable, as we all agree auditors and other players in the financial reporting ecosystem should act with due care. However, I am concerned that the nature of auditing presents unique challenges for making this a workable and fair framework for contributory liability. It is important to recall that in 2004, the board initially proposed Rule 3502 as a negligence-based framework. At that time, many questions were raised as to whether the negligence standard would be appropriate in the context of an audit. Audits are complex and require significant input and judgment from a wide array of professionals with distinct responsibilities, expertise, and experience, all working collaboratively to comply with complex laws, professional standards, and rules. Commenters expressed concern that under a negligence framework, contributory liability could be imposed on a potentially large number of individuals, including anyone who was in any way involved in the chain of events leading to a firm's primary violation, even if acting in good faith or involved only remotely or tangentially. One commenter noted that a negligence standard, quote, would place intolerable pressure on the difficult judgment calls that those who operate in this highly technical field must make on a regular basis. A negligence rule is particularly ill-suited for retrospective judgments about compliance with professional standards, and such a rule would operate as an invitation for after-the-fact attacks on conduct that was, at the time, objectively reasonable, end quote. Ultimately, in adopting the final rule in 2005, the board raised the liability threshold from the proposed negligence to what we now have today, recklessness. The board explained at that time that it, quote, does not seek to create, through this rule, a vehicle to pursue compliance personnel who act in an appropriate, reasonable manner that in hindsight turns out to have not been successful. The board also determined that associated persons should be subject to contributory liability only if their action or omission directly and substantially contributes to the firm's primary violation, with the board explaining that it did not seek to, quote, reach those whose conduct, unbeknownst to them, remotely contributes to a firm's violation, end quote. Crucially, and as you've heard today, today's proposal retains the direct and substantial requirements to link a contributory actor's conduct to a registered firm's primary violation. Even so, I am interested in commenters' views as to whether there are other concerns or considerations regarding the proposed negligence threshold that the board should consider in the current audit environment. If anything, audits have become more complex, involve greater judgment, and include more participants than in 2004 when Rule 3502 was first contemplated. I am also interested related to question 9 in the proposal, whether other potential limitations should be applied to an associated person's level of accountability under a negligence framework. For example, would it be appropriate for the board to hold an associated person accountable for contributory negligent conduct in instances where a firm acts recklessly or knowingly in committing the primary violation? Or what about if a third party engages in intentional misconduct that might otherwise break the chain of causation to a firm's primary violation? Given these questions and other concerns I have highlighted, I wonder whether it is appropriate to move forward in establishing a negligence threshold for contributory liability. Your feedback on the proposal is therefore essential to ensure that the board fully considers all aspects and potential unintended consequences of the proposed changes. I would like to recognize and thank all the staff from across the PCAOB's divisions and offices who have contributed to today's proposal, especially James Capoli, Connor Rasso, Drew Dropkin, Vince Meehan, and Damon Andrews in the Office of the General Counsel, and Martin Schmalz, Michael Gerbit, John Cook, Tian Lang, and Federico Garcia in the Office of Economic and Risk Analysis. I also thank Chair Williams and my other fellow board members and their staffs. I thank Brent Seimer, Katie Driscoll, and Lucia Caramba from my team. And I thank the staff from the SEC's Office of the Chief Accountant for their collaboration and sharing of perspectives on this project. And with that, I'll turn it back to you, Chair Williams.
Thank you. Board Member Ho, the floor is yours.
Thank you, Chair Williams, and good morning, everyone. I support the release of the proposed amendments, but I do so with considerable reservations. The primary reason I support this proposal is that the SEC has existing authority to discipline an associated person for negligently causing or contributing to a registered public accounting firm's violation of laws and rules pertaining to the preparation and issuance of audit reports. I therefore believe proposing an alignment makes sense. That said, I have concerns about the lack of discussion on how the proposed amendments will be implemented, and I'm thus concerned about whether it will do more harm than good for investors in the long run. My concerns about the proposal have three facets. Number one, discouraging auditors from accepting important audit roles. Number two, exacerbating the accounting talent crisis. And number three, causing smaller audit firms to exit the public company auditing business. First, the proposal's economic analysis acknowledges that one of the potential unintended consequences of the proposal is that it could unintentionally discourage auditors from accepting important audit roles if they fear being held liable, leaving those roles to be accepted by less cautious or less qualified individuals. I share this concern, but I believe a more likely unintended consequence relates to retention, in that junior or quote unquote less important audit professionals might choose to leave the public company audit profession altogether, rather than continue to serve in junior audit positions for the duration of their professional careers. If this unintended consequence comes to fruition, investors will in the long run be harmed if, as the proposal notes, less cautious or less qualified individuals rise to fill important audit roles. I look forward to reading the comments we receive on the economic analysis, potential and intended consequences. Second, the proposal acknowledges that the board has discretion in deciding whether to bring charges against associated persons for violations of Rule 3502. However, it is silent as to whether the board expects to bring charges under the proposed negligence standard against individuals holding junior audit positions like associates and senior associates. While I understand the concept of prosecutorial discretion and the prudence of making decisions on a case-by-case basis, and I appreciate Chair Williams' statement today on this point, I am concerned that a failure to signal our expectations up front in the proposal may exacerbate the accounting talent crisis. About 1 year ago, I spoke about the talent crisis facing the accounting profession. I noted the chronic decline in accounting graduates and CPA candidates since 2016. Most recently, we heard reports that just over 67,000 people took the CPA exams in 2022, a historic low over the past 17 years. In fact, the number of people sitting for the CPA exams has declined by 34% since 2016, when a little over 100,000 people sat for the CPA exam. In addition, the Wall Street Journal reported last year that over 300,000 U.S. accountants and auditors have left their jobs in the past couple of years, a 17% decline in industry employment. At the same time, the Bureau of Labor Statistics projected about 126,500 openings for accountants and auditors each year on average over the next decade. If this trend continues, the U.S. labor market will soon have 50% or more of the accountant openings unfilled each year. Why is the accountant shortage crisis relevant to investor protection? Fewer accountants and auditors mean fewer checks and balances and more errors and fraud. If this board or future boards decide to routinely sanction associates or senior associates under the proposed negligence standard, the public company auditing profession will become even less attractive, especially in light of the cumulative steps this board has taken to sharpen the bite of its penalties. For example, by including language in its settled enforcement orders that prohibit associated persons from seeking any form of reimbursement, indemnification, and the like from any source for PCAOB imposed civil money penalties. Third, the proposal's economic analysis acknowledges that its cost may have more impact on smaller firms where direct costs and distraction are less absorbable by the firm's other activities or personnel. The proposal notes that the cost could in part be passed on to audit clients, but then goes on to say that any such audit fee increases are ultimately borne by investors. I understand that some believe that investors do not mind bearing such additional costs if, as the proposal states, audit quality is improved and investors can have a higher level of confidence in a company's financial statements. But I am an investor, and I spent 8 years at the U.S. Department of the Treasury protecting not just investors, but all Americans who rely on U.S. economic and financial stability. And I have reservations about sweeping statements that describe what investors like me and each of you want, particularly when it relates to granular PCAOB proposed rules and auditing standards where there is no quantitative analysis of the costs and benefits. The proposal further recognizes the possibility that some firms could ultimately decide to cease conducting issuer and broker-dealer audits, which could further consolidate the market for issuer and broker-dealer audit services. I have previously expressed concern that investors and the auditing profession can ill afford a reduction of competition in the audit marketplace. I look forward to reading the comments we receive on the economic analysis costs. In sum, I support the PCAOB's rejuvenated focus on its investor protection mandate by 1, modernizing our auditing standard, and 2, taking vigorous and fair enforcement actions to promote accountability and deterrence. However, I feel that we need to be more judicious and exercise greater care so that we do not make the public company auditing profession so risk-ridden that the best and the brightest pursue careers elsewhere. If we make the public company auditing profession unattractive in the name of investor protection, we may be doing a disservice for investors in the long run. I want to thank the staff for their hard work on this proposal, including staff in the Office of the General Counsel and the Office of Economic and Risk Analysis. Thank you.
Thank you. Board Member Stein, the floor is yours.
Thank you, Chair Williams. Good morning to everyone. The proposal before us today may seem very technical, but it's important. It would strengthen the board's auditor oversight program and undergird the implementation of the audit standards that the board is currently modernizing. Under Chair Williams, this board has focused on updating the legacy auditing standards it inherited and that were written decades ago by the accounting profession. The board is doing so to advance its mission of protecting investors and furthering the public interest in informative, accurate, and independent audit reports. Much of that work focuses on the auditor's responsibilities and the obligation of auditors to exercise due professional care. So today, consistent with that focus, the board is considering whether auditors who contributed directly and substantially to the violations of an audit firm because they failed to exercise reasonable care and competence can be held accountable. As today's staff recommendation explains, the board has identified a gap in its oversight of auditors based on almost 2 decades of experience. At present, the board, under existing rules, cannot hold some auditors accountable, even though they were directly and substantially contributing to a registered audit firm's violation of the board standards and rules. The gap arises from a rule that was written by the board about 20 years ago. This rule only permits the PCAOB to bring an action against an auditor when that person acted recklessly or intentionally when participating in or contributing to an audit firm's violations. As a practical matter, of course, only individuals can take actions that violate laws, rules, and standards. The PCAOB, however, lacks the ability to ensure that all individual auditors face the consequences. As the staff has mentioned, the PCAOB currently cannot bring an action against negligent auditors whose direct and substantial contributions furthered an audit firm's violations. This creates an obvious gap in the board's ability to protect investors and the public markets, as Table 1 in the economic analysis suggests. Today's proposal would close this oversight gap, thus emphasizing the obligations under the auditing standards that auditors act with reasonable care and competence. The proposed rule would also align the PCAOB's authority so that no individual who contributes to a firm's violation is beyond reach. It will no longer matter if the person associated with the audit firm is associated with the audit firm that committed the violation, or it's associated with another registered firm that helped with the audit. In today's complex business environment, a number of firms may participate in the audit of a single public company or a broker-dealer, and the board's rules should apply uniformly to each firm's personnel. I support the staff's proposal to amend 3502, and I look forward to receiving feedback from investors and other stakeholders. I'd like to reiterate all the thanks that my fellow board members have been sharing. I'm going to summarize. I want to thank the staff of the Office of the General Counsel for their work and the recommendation. I also would like to thank the Office of Economic and Risk Analysis, the Division of Enforcement Investigations, and others within the PCAOB staff that contributed to this proposal. Thank you very much.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams. I support issuing this proposal, which relates to further aligning Rule 3502 with the PCAOB's statutory authority to investigate and discipline registered firms and persons associated with such firms. PCAOB Rule 3502 was adopted in 2005 during the infancy of the organization as a means of the PCAOB to hold responsible those persons who contribute to violations of laws, rules, or standards that the board has authority to enforce. Since the rule became effective, the PCAOB has been able to assess the efficacy of Rule 3502 and has discerned a need to strengthen this enforcement tool because in too many instances, those persons who play an integral role in firm violations are not charged under Rule 3502. The current proposal, which is informed by many years of PCAOB oversight, seeks to address this need. The proposed amendments to Rule 3502, if adopted, would advance the PCAOB's ability to hold associated persons accountable for conduct that falls short of their professional responsibilities. Through our enforcement program, we have exercised our authority to investigate and discipline firms and associated persons. In fact, consistent with our 2022 through 2026 strategic plan, in the past 18 months, we have been more assertive in pursuing enforcement actions, including imposing in 2022 the highest total amount of monetary penalties in 1 year, over $11 million. However, in a significant number of cases where we have charged a firm with a violation, a contributory actor has not been charged. In reviewing case data from 2009 to 2022, we determined that this was true in almost 2/3 of the cases brought against firms. Firms cannot act unless individuals act. If a firm acts negligently, an individual likely acted negligently as well. The PCAOB can hold a firm accountable for negligently violating PCAOB rules and standards. However, an associated person who directly and substantially contributes to such violations is held to a recklessness standard, which is a higher threshold. This discrepancy is consistent with our investor protection mission. This rulemaking seeks to ensure that persons who orchestrate or facilitate firm violations cannot continue to perpetrate such conduct uncharged and unsanctioned. As we know, such conduct can erode investors' perception of the quality of audits and their confidence in the capital markets. The proposed amendments, if adopted, would institute a negligence standard for contributors. Thus, those who knew or should have known that their actions would contribute to a violation of applicable rules and standards by a primary actor can be held responsible by the PCAOB. If adopted, this enhanced enforcement tool, that is, the ability to sanction persons who negligently cause firms to commit primary violations, has the potential to be a powerful deterrent of misconduct. The proposed amendments contemplate how audits and firms' organizational structures have evolved over time. Given that multiple firms often participate in the execution of an audit and that audit personnel can have various roles and assignments, the amendment seeks to clarify that associated persons contributing to a violation by any firm, not just a firm with which one is associated, are subject to our oversight and could face liability as a contributory actor. Lastly, the proposed amendments are measured and appropriate. They are informed by our oversight activities in the years since Rule 3502 became effective, and importantly, the proposed amendments would establish a standard of liability with which auditors already are familiar, given that the SEC has held auditors accountable for their negligence contributions to primary violations by others. The PCAOB investor protection mandate requires more accountability for contributory actors and more rigorous board enforcement. As such, I reiterate my support for the issuance of the proposed amendments to Rule 3502 and welcome stakeholder input on this important project. I would like to thank the PCAOB staff involved in this rulemaking project, including the Office of General Counsel, James Capoli, Connor Rasso, Drew Jopkin, Vince Meehan, Andrew Damon Andrews, and from the Office of Economic and Risk Analysis, Martin Schmaltz, Michael Garbett, Tian Lang, John Cook, and Federico Garcia. I would also like to thank my fellow board members and my staff for their efforts on this project. Finally, I would like to thank the Securities and Exchange Commission staff, including the staff of the SEC's Office of Chief Accountant, for their support and assistance. Thank you.
Thank you. Unless there are any further discussions from the board, I would now call for a vote on the staff's recommendation. Board Member Gasparti.
In favor.
Board Member Ho.
In favor.
Board Member Stein.
Aye.
Board Member Thompson.
Aye.
Thank you. All votes are unanimous. That concludes the PCAOB's open meeting for today. As there is no further business, this meeting is now adjourned. Thank you for your participation. You may now disconnect from the webcast and teleconference.